Well, good morning or good afternoon, wherever you may be across Australia and New Zealand, and welcome to the PKF Financial Reporting Update for June 2020. My name's Martin Matthews, and it's my great pleasure to welcome you all to today's session. Like many of you, I'm working from home today, so please forgive me if my two cavoodles find their voice and start barking whilst I'm speaking. I'm sure the COVID-19 pandemic has provided many operational and logistical challenges for each of your businesses. As we approach June 30, it's an opportune time for us to consider the financial reporting impacts resulting from COVID to ensure that we are all aware of the issues and have sufficient time to discuss and agree on an approach with your PKF audit team. Even pre-COVID, 30 June 2020 was always going to be an interesting reporting season with the adoption of the new lease standard and for our not-for-profit clients, the introduction of the two new revenue standards, that being AASB 15 and AASB 1058. It's my great pleasure to introduce today's session, which will be led by PKF Technical Director Hayley Keagan. Hayley's an expert in financial reporting and has recently spent time on secondment with the Australian Accounting Standards Board. Before I hand over to Hayley, we want to reiterate that today's session is for you, our clients. We want this session to be as interactive as possible. We have some quizzes to go along as we go along, and we'd love to get your answers to them. Or if you have any type of separate questions, please, we encourage you to send those queries in or throw up your virtual hand using the chat forums at the bottom of your Zoom screen. Thanks again for attending and enjoy the session. And I'll now hand over to Hayley to give you an overview of what we're covering off today. Thanks, Hayley.
Thanks, Marty, and welcome everyone. Got a lot to get through today. As Marty said, there's a lot of changes that we need to be ready for, and then we've got COVID on top of that. So I'll try and touch on all the must-knows. First of all, I'm just going to do the COVID areas first, going through everything you need to know from valuing your financial assets right through to how to account for JobKeeper and other stimulus. So hoping to wrap that up by about midday. It's an hour session, there's a lot in that, there's a lot to know there. After that, I'll get into just our general financial reporting update. So this would have been the stuff that I'd touch on should the pandemic not have occurred. So this year it's going to be about leases, because leases is a hot topic, everyone's implementing it, there's some modifications going on. Also talking about, there's a bit of financial reporting if you were previously preparing special purpose financial reports. During that session, I'll also have a bit of a panel discussion where I'll invite some of the partners from across PKF Australia to give their insights into what the areas are. And then the final part of today's session will be specifically for not-for-profits, because in Australia we have some unique rules for not-for-profits and there's some changes that are going on there. So if you're not not-for-profit, you can obviously go after the special if you are interested in that, please hang around. So first of all, I just wanted to start off with what are like the big key areas. So this slide is more about if I was preparing a financial report, if I was reviewing a financial report, what am I looking for? The first thing I want to see is, have we actually assessed and have we considered the COVID-19 impacts? I'll read the financial report, I'll look at assets, I'll look at all the disclosures and all the notes, just to see if the financial report actually tells the story of what this business is going through during the pandemic. It's really important. I guess most users are going to want to see some kind of comment about COVID-19. So that financial report should tell that story. The second part that I'd be looking at would be leases. So making sure an assessment of leases has actually occurred. Even if the business previously had leases, just look at whether there's comment there as to why. So that'd be the second thing. So first thing, COVID, second thing, leases, and the third thing, this is on the list every year, any transactions that occur outside of ordinary business. So if a business has got business acquisitions going on, or there's some equity raising, some new bank loans coming up, anything like that that's not part of the normal operations, always focus on that. So when I'm reviewing accounts, this is my three that I'll look at. And then that third one will break down into whatever's happening within the business. So getting into COVID-19 impacts, the areas I'm going to talk about today is firstly going concern is really important, particularly if we've got businesses that have been forced to cease trading. I'll have a look at the impact on financial instruments, and that'll include collectivity of debtors or provisioning of debtors. Looking at non-financial assets and impairment, I've got a bit of a question in there on goodwill impairment that hopefully you all can have a go at. And then I'm going to invite along a friend of mine who's also a client who is working in business that can give you an insight into their impact from COVID-19. And then I'll give you the financial reporting impacts from that discussion as well. Also, there's some lease concessions that might be handed out as a result of the pandemic. I'll talk about how you can account for those, how you can account for JobKeeper and other government stimulus. I'll talk about reporting extensions and relief that people are offering. And then finally, Marty will come back in to give us a bit of an insight on what it means for audit. So getting into going concern, what we need to think about is the going concern of the business. And that assessment needs to be done at the date the financial report is being issued. So the going concern assessment will need to be from 12 months from that date. So if our year-end date is 30 June, and we're not signing our report until 30 September, then we will need to do our going concern assessment from 30 September and look out for the next 12 months to see whether the business is going to be able to continue. So when we do this, we generally just look for indications that the going concern basis is still appropriate or if it may have changed. However, given the current climate, what we're seeing is that in most circumstances, there are indicators just purely because of the economic climate. So this year, it's like almost every business has got an indicator for going concern. So it does need a going concern memo this year and does need an assessment. So these are the kind of indicators that you might look for. So if there's been temporary shutdown of operations, if there's been a reduction in your demand for goods or services, or any other income that you might get, if there's any expectations that government policy might affect your future demand for goods or services as well, the length of any current or future restrictions. So at the moment, it seems like restrictions are easing, but yeah, if we get a second wave back, there might be some uncertainty there as well. Availability of resources, so inventory and staff. So during the lockdown, we saw that in some instances, distribution issues occurred and there was trouble getting supplies. Inability to repay borrowings, that's a bit of a no-brainer. If you can't pay your debts, you might have a going concern issue. Reliance on obtaining financing and whether that's actually available. If there's any breaching of loan covenants, or if there's a likelihood of financial guarantees being called upon. So those financial guarantees are probably just sitting in the bank confirmation or the financial report year after year, but given the circumstances now, they might get called upon. And then also data collection difficulties. So that's just a few examples. It's not an exhaustive list, but they're indicators that we may need to go back and visit the going concern assessment. In all instances, it's a great idea to go back and prepare a going concern memo anyway. You're going to be needing to prepare a solvency statement if you're a director of a company that reports to ASIC. And when you're doing that solvency statement, it can pretty much be done hand in hand with a going concern assessment because you're looking at future cash flows and the like. And when you're doing that memo, you'll include assumptions that you've used. So if one of the assumptions is that you're going to rely on an undrawn bank overdraft, then you'll include that in your going concern memo. We are going to continue as a going concern because we have an overdraft facility of $1 million that is undrawn. That's an assumption. Then once that going concern memo is being prepared, it's a good idea just to draft the policy note for your financial report. So from all this information, what do you want the users to see? What tells the story about how your business is going to be able to continue as a going concern, but not give away too much information? So when you prepare the going concern memo, it's always a good idea just to identify exactly what you're dependent upon for going concern. So as I mentioned before, it might be that you've got a bank facility that's undrawn and that's what you're dependent upon. But in other circumstances, there may be businesses that are actually dependent upon the government support, like the JobKeeper program, or it could be a different circumstance where you're relying on doing an equity raise. And in the current circumstances, that might be quite difficult. So identify exactly what it is that the going concern is dependent upon, and then put that within your cash flow forecast. It usually highlights it. So you can see your general cash inflows and outflows going along. You're generally going to be dependent upon the constant cash flows. And if you close, they will suddenly drop away. So if you're forced into shutdown, your cash inflows are gone. Now what are you dependent upon? What's going to do the cash, what's going to be your cash flows for when you're closed to be able to support you through to the future? So have a look for whether you're going to be relying on government stimulus, the length of time for any changes. So if you have that situation where you're in a shutdown, you're not getting cash inflows, how long is that going to last for? Is it going to be 3 months? Is it going to be 6 months? Is it going to be 12 months? Who knows? How long is the government stimulus going to be around for if you're relying on that? And also, are your customers actually going to be able to pay on time? Because your previous cash flow forecast that you might have done would have been based upon customers doing their normal terms. But now that we're in this economic climate, they might be pushing it out, say 30, 60, 90 days. Some of them might be bad even. So you've got to build that into your cash flow forecast as well. If you are relying on undrawn facilities, it's a good idea to confirm that they are still available. And if there's any financing that is needed to cover shortfalls, just have a confirmation that you're going to be able to get it, or have some kind of plan of where it's going to come from. Now, once you've split out all these dependencies and identified what the business is relying on to continue, then assess them as to whether they're material. So if they are going to have a material impact on the future of the business, that's when we need to start disclosing them in the financial report. So if I go over to here, this will talk through the disclosures. We've done our assessment and we've come up that we don't have a material uncertainty in there as such. There's a few things that are uncertain, but none of them are material. However, the users will probably expect us to make comment about how our business is going to continue through the pandemic. So we'll still disclose the indicators and judgments that were applied. So they might be that we've got that undrawn facility that I mentioned previously. And then putting in the director's commentary as to why there's no material uncertainty. So just putting in a bit of just wording just to explain it to the users. It's very much a storytelling exercise. So an example there would be where a business has suffered a drop in sales of around 20%. However, they've got sufficient cash resources to suffer up to a 50% decrease in cash flows. So there's no material uncertainty there. But you may tell that story to the users of the financial report so they understand why we don't have a problem with going concern. The second one is where we have a material uncertainty, but we're not sure whether we're going to make it yet or not. We haven't actually decided we're going to close the doors. So where we sit out here is we need to make a disclosure about all the indications and judgments that have been applied in our assessment. We need to talk about the financial impact of the indicators. So if we've got a drop in cash, the financial impact might be that we're not going to be able to pay our loans anymore. And then put in the commentary about why we're in this situation and what the plan is to get out of this situation as well. So an example where you'd need to include this kind of disclosure would be if a business has suffered a drop in sales of 50%, they may be relying upon the JobKeeper and other subsidies from the government. However, we're not sure if the JobKeeper subsidy will be continued long enough until we actually get our sales back to a sustainable level. So in that instance, you would need to put that material uncertainty in there and explain that we're not sure because we don't know when our sales will be able to return to a sustainable level. And then the final one is where the entity is not a going concern. This isn't a good situation to be in. It's basically you've exhausted all your cash resources. You understand that the business is not going to be able to continue and you're taking steps to wind up the business. So if this is the case, you'll explain that. It'll definitely just be through commentary. However, you'll also likely change the way in which you measure your amounts in the financial report because you'll take it to a liquidation basis. If you're going to close the business, how much are you going to get for selling off your buildings, as opposed to carrying them at cost with accumulated depreciation. So an example of this was a business was forced to close and has insufficient cash resources to cover fixed costs of leasing equipment. And the business has resolved to liquidate due to potential length of closure. So the key is here that they've actually resolved to close. So that's why we're concluding that they're not a going concern. Now with the second and third examples in there, they will have an impact on the audit report. So that second one, if you need to disclose a material uncertainty, there will need to be an emphasis of matter in the audit report, just so that anyone who's using that financial report, if they go straight to the audit report, they'll see that the auditor has said, hey guys, something different this year. You need to go and read this note about the material uncertainty of going concern. Now, same goes for the last one as well. And that's on the basis that if you're in this situation, you would have actually changed your financial report to be prepared on a liquidation basis as opposed to a going concern basis. So wherever something like that occurs, there's always going to be an emphasis of matter in the audit report. If you decided to use the going concern basis, even though the liquidation basis would be more appropriate, then the audit opinion might be modified slightly different to have a qualification. But hopefully we don't end up into that third box anyway, and we're all going to be continuing either with some uncertainty or hopefully with none. If you're stuck with preparing a going concern memo, there is some great guidance that's been issued by the AASB and the AASB, so that's the Accounting Standards Board and the Auditing Standards Board. There's a link here. I will distribute these slides afterwards, so you should just be able to click on the link, but it gives you a step-by-step guide on how to do that assessment. Okay, so another area impacted is financial instruments on your financial report. So if you think about your balance sheet, a financial instrument will be any balance that will give rise to another financial instrument if you're to sell it. So that I've given the actual definition per the accounting standards there, which is a bit bland, but the idea is your debtors will be settled by cash, which is also a financial instrument, so therefore it's a financial instrument. So the list of common financial instruments are debtors. The potential impact from COVID-19 would be the expected credit loss model. So under the simplified method, which is where you use the percentages per the aging of your debtors, that will need to be adjusted for future looking impacts from COVID-19, because it's likely that your debtors will, your customers will suffer a financial impact, and that there is more likelihood that debtors will become impaired. So the percentages that you used in the matrix last year for your debtors ECL model will not be appropriate this year. You'll need to do it again this year and potentially increase those percentages. Loans receivable. So when we do loans receivable, we generally use it's the general model for expected credit losses. And when we do the general model, what we look at is the risk rating. So if the loan last year was considered a low credit risk, and then this year, because of the COVID-19 impacts, it's changed to a moderate credit risk, what we need to do is a full impairment assessment. So you can only do the 12-month impairment assessment, which is business as usual, provided that risk hasn't changed. But in many instances, that risk will have changed because of impacts coming out from COVID-19. So keep that in mind, that you can't do the same method for if you're using the general model of ECL. You need to go in and do lifetime credit losses if that credit risk has changed. And take this into account for any intercompany loans as well. It can get quite complex there. Investments. So all of our investments now need to be carried at fair value under accounting standards, but fair values are likely to have changed from COVID-19. Also keep in mind if you've got investments that have got foreign exchange and like, same for debtors, loans and everything, because FX is having an impact from COVID-19 as well. We're seeing the dollar drop a bit. Financial liabilities, they're not immune. There are modifications to repayments. So in some instances, banks are deferring repayments or are switching to interest-only arrangements. And there's also the risk of potential breaches in financial liability. So if you were to breach some of the terms, the loan may become at call, which means the non-current portion might need to go to current. And then also, if you've got derivatives going on, keep in mind of fair value changes, particularly if you're using fair value models. That's always interesting because discount rates and the like have changed. And be careful with hedge accounting as well. So just a closer look at ECL provisioning, because it is quite complicated. So under the simplified model, so I was mentioning this at our training last year for those that were there, we need to do a matrix where we split up our debtors per aging. So we've got like our current debtors, our 0 to 30, our 30 to 60, 60 to 90 and 90 plus. And then what we'll do is based on our historic collections or write-offs, plus a look into the future of what we expect to collect, we'll put a percentage against each of those categories. And with the ECL model, one of the main changes was that even the ones that sit within current will have a percentage applied to them. So you take that model that we developed last year, because it was a new standard last year, and now this year, Those future-looking impacts is what needs to change. So you might want to start stratifying your debtors based on their facts and circumstances. So think about the geographical location and local government restrictions, because debtors that are operating in the Asia region might be a little bit different to those operating in the European region. Also, consider the impact of late paying debtors. That does have an impact on those percentages. So if you see a trend that your debtors are now paying up to 90 days late, then you would expect to see an increase in those future looking impacts that goes into that percentage in the simplified model. So general model, as I mentioned before, this is what we use for our loans, our intercompany loans, or if you're an authorised deposit taking institution, you might use this for all of your loans, or if you're in the business of issuing credit. So what happens under the general model is that you assign a risk rating, and if the risk has increased from the prior year, you're going to move to a lifetime losses model. So that means you have to take up the lifetime expected losses for that loan. Have a think about government guarantees in some jurisdictions, because some loans have been guaranteed. So that might have a positive impact on your general model for ECL, but definitely adjust for time value of money if payments are expected to be delayed. So if the payments are going to be beyond 12 months, you definitely have to adjust for NPV when you're doing your general model calculation for lifetime losses. Definitely stratify. The great thing about the general model is that we don't have to apply it to our entire debtors ledger. We get to apply it on a loan by loan basis. So the risk might be different for each receivable. So use that to your advantage. In any instance, whatever you end up with these ECL provisionings, disclosure is key. So I'd expect to see an increase in the provision for debts, whether it's on trade debtors or whether it's on loans, and just putting in some wording to explain why, to say that our debtors are either guaranteed by the government because they're in this jurisdiction, so therefore there hasn't been as much increase as you'd expect, or to say that yes, our provisioning has gone up significantly because all of our debtors decided they didn't want to pay until after the pandemic. Whatever the answer is, if you disclose it there, the users will be able to understand it. All right, so non-financial assets now. They're basically anything that's on your balance sheet that's not a financial instrument. So areas that it might impact is fixed assets, any investment property, intangible assets including goodwill, exploration expenditure if you're into mining, inventory as well, and deferred tax assets is an interesting one. So the potential impacts that can happen on these areas of your financial report is that they may be impaired if they're carried at cost. So only assets that are carried at cost can be impacted by impairment. And there's particular rules about when you've got to do the timing of impairment testings. We also have a thing for indicators. So if you're carrying, say, your land and buildings at cost, you will only need to do a test for impairment if there's an indicator. So last year, business as usual, you probably didn't have any indicators. But this year, given that COVID-19's come around, there's going to be a lot more indicators popping up, which means a lot more testing. Also, if you do interim accounts, so if you've got 2 sets of reports that you do every year, you're going to have more testing again, because you're going to have those indicators come up at both December and then at June as well, or whatever your reporting time frame is. So the more indicators, the more testing there is to be done. So get prepared for that. And when you're testing, you do need to adjust the discount rates and the uncertainties, because generally we're doing DCF models, or we're looking at future cash flows for our impairment testing. And then we bring it back to today's value of money, and we'll use discount rates. And we'll also apply uncertainties to cash flows. Make sure you're not double counting those risks though, because sometimes people will put in a probability of a decrease in cash flows, and then they'll also build that into our discount rate. You only need to consider each risk once, either within the discount rate or by adjusting the actual cash flows itself. So don't double dip on those. Anything that's not carried at cost, just carried at fair value. So just have a think about fair values that may change. And also understand uncertainties in fair value models. So if you're using fair values for things like shares that are in the stock market, it's quite easy to get the fair value. But when we get down to fair valuing things like land, we use models for that. And those models generally go back to a DCF kind of style model anyway. So we're looking at the cash flows. And then built within those models is an amount of uncertainty in the market. So if I take the example of land, we will be looking at what cash flows that land can generate if it was under another use, or we may be looking at recent sales data. But the market might have dried up a bit, so therefore we end up with an amount of uncertainty within there. So you need to have a think about those uncertainties, and if you can quantify it. Now, I did see a publication that came out from Association of Valuers, I think it was, that said that there's a method for quantifying these uncertainties. It's a good idea just to include that in your financial report, and also discuss it with your auditor early on, because if that uncertainty in that fair value becomes a material amount, it may start to have an impact on your financial report. So do be aware of that. And now, just moving into an example. I've got some questions coming up after this, so please read through this carefully. Freddie Fit has acquired a number of All the Time Fitness gyms over the past few years, which make up his portfolio of fitness centres across Australia. As a result of the business acquisitions, Freddie Fit has accumulated goodwill of $15 million, which is tested annually for impairment. In previous years, the goodwill impairment test has been performed during April in order to coincide with the interim audit. So I'm assuming that they've got a June year end, and then the interim audit occurs in April prior to the year end. And then in March in 2020, Freddie Fit was required to close all these gyms due to COVID-19. As a result, the membership revenue ceased. However, poor Freddie is still required to pay the fixed lease costs of the gym equipment at each of his All the Time Fitness sites. Due to the increased pressure of lost revenues and continuing costs, during June 2020, Freddie Fit unfortunately breached his bank covenants. However, he busily got about contacting his bank manager, and in July 2020, he was able to refinance to avoid the bank covenant issues. So with those facts in your mind, and also keeping in mind that it's a 30 June year end, if we can open up the polls now, I'm hoping we can put some answers into these questions. So when should Freddie Fit perform his impairment assessment of goodwill? Should it be in April, which is what he did in previous years? Or should it be in June, because that's when the year end is? Should it be both April and June? Or is impairment testing just not needed this year? And then if he goes along and calculates that impairment loss, and if the loss at June is not as bad as it was at March, because at March was when he was forced to close down, would Freddie Fit be able to use the June value for his recoverable amount in his goodwill assessment? Thirdly, would Freddie Fit need to reclassify loans payable to current, as at his June financial report, due to breaching the bank covenants? And then finally, how should Freddie Fit account for the refinancing of the loans in July? So those last two questions are kind of linked. If everyone can start putting in their poll questions, I get to put mine in as well. Hopefully I got them right. Okay, now I don't think I get to see the answers come up, so hopefully someone will jump on and help me with that. Okay. That's interesting. So goodwill is one of those ones that needs to be tested annually because it's not subject to amortization. So any intangible assets that don't get amortized must be tested for impairment annually. Okay, voting's still going. Okay, I'm going to close voting in 10 seconds. All right, I've got the answers here. So 67% of people said that for question 1, Freddie Fit should perform his impairment assessment in both April and June, which is right. Because goodwill needs to be tested annually, which is the April one, because he usually gets it done in April. And also when there's an indicator. So there was an indicator in June because of the bank covenants being breached. Now, if the impairment loss is less at June than what it was at March, would he be able to use the June value? 86% of people came back saying yes. I'd probably err on the answer of no, because with goodwill, you need to test for it annually at the same time every year. Freddie's time for testing goodwill is in April. So every April he needs to test his goodwill. And when you apply your goodwill test and you apply your loss, your impairment loss, they cannot be written back for goodwill, unfortunately. So if I was going to be applying the standards to the letter, I'd probably say no, he will have to take that April one. And it's just, it's really poor timing because unfortunately that's when it's at the lowest of the market. If you were to take the June one, obviously it'd be a better outcome. But it's some of the tricky situations that we're facing this year with COVID-19. Thirdly, would Freddie Fit need to reclassify his loans payable to current? Yes, he would. Because what we talk about is that the conditions that were present as at the reporting date, as at 30 June. So as at 30 June, he had breached the covenants and those loans were actually due and payable or at call. And then the fourth one, how should he account for the refinancing of the loans in July? So we've got 43% says adjust the loan per the new agreed terms in the financial report, and 71% say disclose the new agreed terms. It would be a disclosing event, so B would be the answer here, because the refinancing event occurred within July, which is after that balance sheet date. So those terms won't enforce at 30 June, so all we can do is disclose it and write a story about it. So thank you everyone for participating in that poll. All right, so other ways that COVID-19 might impact your financial reports, rent concessions are great. So the International Accounting Standards Board has recently released an amendment to AASB 16 or IFRS 16, which will allow COVID-19 related rent concessions to flow directly through to the P&L. So how that will work is if you have negotiated to not have to pay your rent for 3 months due to COVID-19, instead of having to recalculate your lease that goes onto the balance sheet, you can just put that through straight as a benefit or an income amount in the P&L. So you will debit the lease payable and you will credit income from rent concession. So that's a great thing to come through. Other areas to keep an eye out for would be revenue recognition, particularly if you have estimates that you use for rebates or if there's variable consideration. Have a think about provisions and adjusting discount rates. Because discount rates have changed across the board, and also probabilities, because if it looks like you're going to be putting off staff because of a downturn in work, then the probabilities of the provisions being paid out might increase. Also, employee remuneration, like if it's estimated based on performance of the business or share-based payments, all of those estimates might need to be adjusted. And always have a think about post-balance date impacts. The environment is just changing every day. There's new announcements for governments every day. So even when you get to 30 June, if that's your reporting date, or if it's 31 March, whenever it is, after that date, there's going to be more news that comes out. So have a think about what impact that has on your business and whether you need to disclose that in the financial report. All right, so now I'll introduce a friend of mine who is also a client. So Nathan. He works at Pure Fishing. Pure Fishing is a leading global provider of fishing tackle, lures, rods and reels. They've got a portfolio of brands. Some of them you might know, Abu Garcia, Berkeley, Penn, Ugly Stick and the like. Now Pure Fishing is owned by a private equity firm, Sycamore Partners in the US, and they have operations in 19 countries and a workforce of over 4,000. Nathan is a chartered accountant. He's got over 11 years experience. He's worked in public practice and commercial accounting roles. He's currently the finance director of Asia Pacific region with Pure Fishing. He's responsible for their commercial strategies, financial performance, reporting, and just general management of the financial operations across that region. So I'm going to hand over to Nathan. He's just going to give you a bit of an insight into how COVID-19 impacted him as the finance director of Pure Fishing, and then I'll come back and see if we can help him out with some of the accounting aspects of that. Thank you, Nathan.
Thanks, Hayley, for the introduction, and hi, everyone. As Hayley mentioned, I'll just give a brief rundown on what COVID meant for our business. So I guess starting with what happened in January, we've been observing the impact of COVID-19 in January in China, and we've been working to shore up our supply chain since January. But it was really late March when we all experienced that rapid wave of fear and uncertainty flow across our society and economy in ANZ. So for our business locally, that meant impacts relating to our customers. They halted payments, they paused purchasing of our products, requested financial assistance from us in the form of discounts or extended payment terms or rebates. And then our consumers, they were heavily impacted with the general movement restrictions that we saw, and also regionally inconsistent restrictions around fishing, boating and camping. So for us, it was quite a shock. And we really responded to what we were seeing by essentially developing a business continuity plan, which had a 3-month focus to it. And we did things including we took our customer-facing sales team off the road. We implemented a reduced hours plan for our employees and a working from home roster. We revised their revenue assumptions, as well as our margin rate assumptions as FX volatility really increased during this period. Reduced our discretionary spend around travel, entertainment, and traditional advertising promotional spend. We also pushed out payments to our suppliers and reduced forward purchase order volumes, I guess, to align to our revised revenue assumptions. And we were lucky to participate in various forms of government assistance. So we saw wage subsidies in Japan and New Zealand, as well as the JobKeeper, which we're all familiar with in Australia, and payroll tax waivers in various states in Australia as well. We also turned to our landlords and negotiated some rent assistance there in both Australia and New Zealand. And we're able to get some partial rent waivers and deferrals in return for some lease extension. So we're also able to, I guess, leverage a favourable political stance on fishing, which was the case in most states in Australia at the height of the restrictions. And we also increased our investment in digital marketing and our social media platforms, and also selling programs with our key online retailers, as we saw online shopping really spike when a lot of people were stuck at home. So I guess during the 5-week period from the end of March to the end of April, our revenue was significantly down year on year. But since the start of May, we've experienced a really complete turnaround of confidence within the fishing category, supported by increased consumer participation with significant year-on-year retail sales growth. And this is true for all markets around the world. Hearing reports from our colleagues in the US and Europe that participation and retail sales are significantly up compared to last year. So our biggest problem now is supply chain and fulfilling that demand. So we're also focused on how we can position our company to really take advantage of these opportunities at the back of this period, due to, I guess, consolidation in the marketplace. We're gonna focus our investments in our supply chain to shore that up. We've strengthened a lot of our consumer relationships. And we're seeing, I guess, an increase of this, what we're calling the shift to digital from a selling channel perspective. And we also want to make sure that we can encourage all those new participants to fishing to have a good experience and hopefully develop, I guess, a lasting interest in the sport. So we can turn this into a long-term gain for us. So I guess for what we've gone through, I guess we would say we feel like what we're experiencing right now is is a bubble in terms of demand. We don't think it'll continue this way forever, but in general, we feel like the fishing category and outdoor sports is counter-cyclical, and so we've got reason to remain positive. So for us, it's been an interesting journey going through this period of time, and we're really confident that out the back of it we can put the business in a better spot than it was, and generate growth in the future. Thanks, Hayley.
Oh, thank you. It's interesting insight. So I took a few things out of that. First of all, those initial impacts where the customers were halting their payments. So I guess your debtors ran out a fair bit. Sales went down. And you even had customers reaching out for financial assistance. All those kind of things would lead into what I was speaking to earlier about doing a going concern memo. So trying to build in those drops in cash flows or those push outs of the customer debtors to see where you actually land in a going concern perspective. When you mentioned that you also did something similar in terms of pushing out your payments to suppliers, I'm just interested to know, like, was there any kind of negotiations that went on there in terms of like how long of a term it was, or whether it attracted interest or anything like that?
Yeah, that's right. We negotiated with our major suppliers, which are generally third-party manufacturers in China and similar places, to essentially get another 60 days payment terms from what we normally get with those customers, those suppliers. Sorry, no interest was part of that negotiation, and most of our suppliers were able to come to the party there, which was helpful.
Okay. And it's just interesting to note, because it can sometimes, it can sometimes lead to, like, the line between trade payable and supplier finance, it's really fine. So when you start negotiating those kind of terms, if we get to something that could be longer than 90 days, or if you've got other loans, if you've got like a 90-day bill facility, we might be sitting into that financial liability situation. Definitely, if there's interest, it would be indicating that we're in a loan situation as opposed to a trade payables situation. So that's a situation that can come up uniquely just because of COVID-19. Now, I think we just had a question come in. So Hazel's asked, if the business reduces salaries by 80%, but then say if they can, they will repay the short if the cash flow improves, should the business accrue this as it is fairly probable that it will happen? Yes, if that's what the agreement is, if they've got the obligation there to pay it, then yes, they should be accruing that. So yeah, as soon as you've got that obligation to make that payment back, if it's based on the future and there's a probability there, then you assess the probability and take up the liability based on that. Hopefully that answers your question, Hazel. Now, just going back to Nathan's situation. So another note that I had here, you said you did end up applying for the JobKeeper. But with that roller coaster where you went from having that drop in sales and then you've kind of picked up and now you're actually working to capacity, are you still claiming the JobKeeper now, or is it something that dropped off?
Yeah, so I guess that 5 week of, I guess, significant revenue reduction year on year happened for us for largely during April. So we're actually 40% down compared to last year during the April month. And it's really been from May that things have turned around for us from a turnover perspective.
Yeah, okay then. Yeah, it's interesting. I've got an example coming up on JobKeeper, so hopefully that'll work into that as well. I also heard you talk about the rent concessions that you negotiated, which I will be talking about soon. I'm really keen to hear, what exactly were you able to negotiate with your landlord?
Okay, so we were able to negotiate both a partial waiver,
yeah,
and also a partial deferral of our rent for the next 6 months. So the way the deferral is going to work, we're going to, I guess, pay that over the remaining term of the lease.
Okay.
And then the final part of that negotiation, something that the landlord asked us for, was an additional commitment. So they initially asked us to exercise one of our options. but we ended up arriving at a revised option period of an additional 6 months for extending our lease.
Okay. All right. So if you hadn't have extended that option, you wouldn't have got the other 2 benefits of the rent waiver and the rent deferral. Right.
Yeah, that's fair to say. Yeah, they're all part of the same negotiation.
Okay. Yeah. Nice. So that's quite important, and I'll bring that into an example shortly. But thank you for that insight, Nathan. I've just had another question come in. It says, can you please explain how you handle the foreign exchange exposure, especially in your exposure to Chinese and US dollars? Yeah,
so for us, we actually don't participate in any derivatives for hedging. So for us, we're just buying on spot. So we obviously experienced a wild ride in regards to the currency, and we're checking it every day, and we're happy to see that it's hit 70 cents. But we obviously know what our forecasted purchases are, and we can calculate what they're going to cost us, and that was part of our, I guess, our plan in terms of determining our reduced profitability as a result of FX.
Okay. Well, thanks for that insight, Nathan. Good to have you along today.
Sure, thanks.
All right, I'll catch you later. Thank you. So I'll move on now. This is good timing. I was just going to talk about the COVID-19 rent concessions. So what we've got is the International Accounting Standards Board and the Australian Accounting Standards Board has released an amendment to AASB 16 leases. And this will allow lessees not to assess whether there is a change in lease modification. So this is what's called a practical expedient. So if you are able to apply this expedient, then you can account for the change as if it was just a change in variable payments. It means that you can put that rent waiver through as straight to the P&L as a benefit. So you'll debit your lease payments and you'll credit through to the income. These are the 3 conditions you've got to meet to be able to use this expedient. So the change in lease payments has resulted in revised consideration, so such as a rent waiver, that is substantially the same as or less than the consideration for the lease immediately preceding the change. So it has to be a rent reduction, can't be a rent increase. It's not really a concession then, is it? So second one is that the reduction in lease payments will have to be originally due on or before 30 June 2021. So it's got that time frame for it, just to make sure that we don't use this into the future. And that there is no substantive change to other terms and conditions of the lease. So this is only if you are actually the lessee. There is no relief provided for lessors, unfortunately. So with those conditions in mind, and with what Nathan just mentioned previously, so it was there was a partial waiver, so that's where he doesn't pay the rent at all. A partial deferral, which is where they paid it over the remaining term of the lease. And then the third condition was that he had to take up the 6 months additional commitment. So what that means is that, unfortunately, Nathan, you won't have satisfied these conditions to be able to use this expedient. Reason being is that there was, you didn't satisfy C of the conditions, because having the extra commitment for the 6 months at the end of the lease, that's a substantive change to other terms and conditions of the lease. So unfortunately, it means you can't use this, you can't put that rent waiver through to income. But if you were able to get those first 2 ones on their own, where you've got the rent waiver and the rent deferral, then you can actually put that through to the revenue side, which is a good outcome. Now, these are some examples on how this expedient works. This is straight from the standard. I'm not going to take you through it in detail today, but it will come out in the slides. So it gives you 4 different circumstances of what may happen during a COVID-19 rent concession negotiation and how to account for it, and the journals there. So you will get that at the end. And in Nathan's situation, we're going to have deferred lease payments only, and we're also going to have to extend the term of the lease. So it's pretty much going to end up like a new lease. All right, so government stimulus and JobKeeper. So what is this stimulus package for? It's to subsidise the cost of wages and to assist businesses who have experienced a downturn as a result of COVID-19. And that's so that businesses can continue to employ staff. That's the idea of the policy. They want to keep people employed so that we can keep that unemployment rate down. It is available to businesses who employed staff at 1 March 2020 and have experienced a decline in turnover. There's no requirement to link that decline to COVID-19. You could have just really done a poor job at running your business. But you also have to need to continue to employ your staff for the relevant periods, which is being up until September. So if the staff drop off before then you're not entitled to the JobKeeper. Now that's a really brief overview. The eligibility for JobKeeper is really complex. There's like up to 15 different tests that can be used to see whether you can claim the JobKeeper. I'm not across them all. You do need to demonstrate a decrease in turnover during the period. It's like some businesses it's 20%, some businesses some businesses it's 30%, some businesses it's 50%. You must continue to pay staff over the period. And then the minimum amount that each staff gets must be $1,500 a fortnight, and that's before you do withholding tax and the like. Interestingly enough, government entities are not eligible to apply for it. So the relevant period for when you are entitled to get the JobKeeper is from the start of the month in which you first satisfy the decline in turnover test. So one of those up to 15 different tests that I was mentioning earlier. So if that happens in April, that's great. You'll then continue to get the JobKeeper up until September. Or you'll have to stop earlier if you stop employing the employee who's registered under the JobKeeper. The amount that it is $1,500 received per fortnight per employee. Very simplistic overview. It is a complicated stimulus package. Now, I've just got an example to try and help you understand it. So we've got Trades United. They're a company employing 4 staff, including directors. During April, there was a decline in service calls and a large construction customer deferred a large job. Due to the downturn, the owner predicted sales would decrease by 35% for April compared with the same time last year. So that's one of the tests that you can satisfy. And then in noting that, the business owner then ensured that all staff were paid a minimum of $1,500 per fortnight to secure the JobKeeper eligibility. They registered for the JobKeeper payments by nominating April as the eligibility month. And then in June, that large construction customer came back and agreed to proceed with the job. As a result, the turnover has increased to be 60% more than the same time last year. So I've had a big turnaround, similar to what Nathan was mentioning with his roller coaster. So Trades United intends to keep all staff employed until the large construction job is complete at the end of July, and afterwards we'll reduce the employed staff to only 3. So that's after July, but before September. So let's see how much they get. They have satisfied the test in April. So therefore the increase of the turnover in June, up to 60% increase, has no impact on the future payments. This is based on how it's written at the moment. However, Trades United may intend to terminate an employee in July. Therefore, the JobKeeper for that particular employee will need to cease for the remainder of the period. So I've done a quick calculation there to find out how much Trades United gets. It's a very simplified example. So with 4 staff at $1,500 per fortnight from April to July, he'll get $48,000. And then 3 staff from August to September will get $18,000. So the total payments that they're entitled to is $66,000 from the JobKeeper. Now this is as per how it's written at the moment. It's interesting to keep a check on the news though, because things are always changing. Now for Trades United, he's probably quite confident that he's going to get this $66,000 right through to the end of September. But if we take this example and we change it to a daycare centre, we've suddenly learnt that they're not entitled to the JobKeeper beyond July. So the amount's changed. So what you might have thought was the amount that you're getting, policy has just changed in the last couple of weeks, which has changed it now. So have a think about that going forward. This will impact how you do your estimates, and it may impact what you need to disclose in your financial report. Now that we know the amount that Trades United is entitled to, we refer to an accounting standard, which is AASB 120, Accounting for Government Grants and Disclosure of Government Assistance. Now, what this says is that you can recognise the revenue when you comply with the requirements. So the requirements currently are the decline in turnover test and making sure that your staff are still employed. Then you recognise the revenue on a systematic basis as the costs are incurred. So for instance, as the payroll is actually paid. So as you're paying the amounts out to the staff, that's when you can recognise the income. Interesting in this standard is that it allows you to either present it as income or you can net it off against the payroll expense, so offset it against the expense. However, if in the future it becomes repayable, it gets treated as a change in estimate. So therefore, if some of your staff leave and you've already recognised the revenue, you'll then need to change the amount and it'll go straight through to P&L. So you'll have to do the change in the period in which the estimate changes. Now, this relates to for-profits only. So if you're a not-for-profit, the rules are vastly different. So hold on to the end of the session for the answer on how the not-for-profits do it, but it's very different. But for the for-profits, just as you're paying the payroll out, that's when you recognise the income. Choose to show it as an income amount, or you can offset it against the payroll expense. When I talk to the guys that prepare tax returns, though, they say to me, don't let your clients offset against the expense because they'll never find it. Because it's quite important to be able to separate it for reporting purposes on tax returns and the like. So if you do intend to offset it, just keep some kind of track of it so that when you get to your tax return, you are able to split it out. Okay. All right, I'm just checking if there's questions that have come here. So I've got a question about how have you recognised the JobKeeper subsidy. I'll just ask for clarification if that's a question for me, if that's a question for perhaps Nathan, as to how he recognised the JobKeeper subsidy. So the JobKeeper subsidy can be recognised on a gross or net basis. How have you done it, Nathan?
Yeah, we've essentially netted the wage subsidies received against our payroll expense in the month when it relates to the payroll. We're a December year end for reporting purposes, so not too critical for us, but maybe for some junior ends it might be more critical.
Okay.
Thanks.
Now I've got another question about whether we can, so back to lease concessions and whether we can still apply the lease concession treatment even if it's not finalised. So the lease concession treatment will need to be finalised prior to 30 June for you to be able to get the benefit into your financial report for 30 June. So if you don't agree to it until afterwards, unfortunately that's when the benefit is and that's when you'll have to recognise it. However, if it's kind of in progress and you've agreed it, but you don't have the information until later on, you can go back and change it. So there's a bit of a cut-off issue there. Generally, try and get those agreements wrapped up before you do your financial report, so you've got that benefit to put in there. Another question in related to the rent concessions. So the transaction where we go debit the lease payments and credit the income, you can put that income in. Is the credit income declared when declaring JobKeeper income? So the rent concession will be declared when you've got the right to receive the rent concession, when you've negotiated that rent waiver in. That's when you can recognise that income. The JobKeeper income, you'll do that one separately. So the JobKeeper income will be recognised when you have actually paid the employees if you're under a for-profit business. But if you're a not-for-profit business, the JobKeeper income is going to be very different. So please keep that one in mind. Okay, so I think that's on. Okay, if you're impacted in May or June by the 30% reduction, can you still claim for JobKeeper from the month of impact? From my understanding, I believe that you can. However, it's not my area of expertise. So this is definitely an area for the tax advisors and the like or business services advisors to tell you about. Because it's changing all the time. It's legislation that impacts it's linked to your BAS statement and how much income you're making. So I'm not an expert in the field, but when I did my research initially, the moment that you qualify for the JobKeeper, you'll start getting the payment from that point forward, regardless of whether your income goes up or down in the future. Okay, presumably payroll tax refunds and federal government cash flow boosts can either be accounted for income or offset as the relevant expense. No, they're actually done a little bit differently. So the payroll tax refunds, they will, depending on what state you're in, they're generally going to be a reduction in the expense because it's a waiver of the expense that you would have otherwise had to pay. So you just won't put in the payroll tax expense amount for the ones where you get the refund. The cash flow boost, I believe that one is a straight income amount, and that will come under this AASB 120. So when you are entitled to receive it, you'll put it in as the cash income then. Another question, do you put it in as other income and no GST? Is it the same for government grants and stimulus from BAS? I'm not sure exactly. So this must be for the JobKeeper. I'm not really sure about the GST implications for the JobKeeper, sorry. And the stimulus from the BAS, I think that might be in relation to the cash flow payments that came from the government. So the cash flow payments that came from the government, they definitely go through as income or cash when you receive them. The JobKeeper one is the one that I've spoken to with the example, and then the payroll tax one, generally you'll offset the expense because you actually don't have to pay that tax anymore. Hopefully that answers that one. The ATO cash flow boost payments accounted for in the same way as the JobKeeper. I've answered that one already, so that one will go through as income when you receive it. How do you recognise a loan repayment deferral, including its interest? Okay, so if this is talking about the one that you've negotiated with the bank, a loan repayment deferral, you'll need to go through and change your amortised cost of that loan. So if you're just extending the loan, so just say you've got a deferral for 6 months where you're not making repayments, you'll go back and recalculate your amortised cost for that financial liability, and then you'll flow that through. So generally you just won't have the payments go through, the loan will just sit at its normal amount, but the interest will still keep accruing on it. But for loan repayment deferrals and those style negotiations, they're all really different. So it depends kind of situation. You need to look at the terms that have been negotiated and then decide which way is best to go. And then the final question before I move on, if your business is not operating in a going concern prior to COVID situation, then do you still require to put COVID situation on the financial statements? If COVID's had no impact, and if you still had going concern issues regardless, just report those. The idea of the going concern disclosure is just to talk about exactly what is impacting this business's ability to continue as a going concern. If it had other issues and then COVID's highlighted those issues and made it worse, explain that story. If it had other issues and then COVID's had no impact, then that's how you will leave it. It just depends on the business's individual circumstances. Okay. So another question, are you saying the JobKeeper receipt is treated on a cash basis rather than accruals, even though you know the amount at the month that you will receive mid the following month? No, I wasn't trying to say that. Sorry for the confusion. It's definitely an accruals basis when you are entitled to it, but you have to recognise it on a systematic basis as you are making the payments to employees. So you've got to match the income and the expense is the principle that we're doing. I think I've got through all of the questions, so I will check in later as they come up. And I can't stress enough that not-for-profits have got different rules for this. So, and it is vastly different. So if you're in the not-for-profit land, ignore the AASB 120 stuff that I've been talking about in those examples I just went through, and I'll have another example in our last session. Okay, so just quickly, reporting extensions and other relief that's available. So AGMs now be online for the use of technology, listed and non-listed entities. However, because that was legislation that went through on the 6th of May and it only lasted for 6 months, it expires on the 6th of November. So keep that in mind that your AGM will be held after the 6th of November and you intend to use online method for delivery of the AGM, that you might need to go back and check if you actually are allowed to do it through your constitution and the like. If it's before 6th November, you know you're right, you can do it. But if it's after that point, just do a double check to make sure you can. Now, ASIC has extended lodging financial reports to both listed entities, which is great. So anyone with a year-end date between March and June will get that 1 month based on when they can lodge their financial report. And in addition to that, ASX supported that for listed entities. So they're allowing the 1 month extension for those that are listed on the stock exchange. However, it only applies to the full financial report only. So you still have the 2 months for doing the preliminary results in the 40, unfortunately. Now, if you're in the not-for-profit area and you report to ACNC, they've got some different relief, which I'll report on later in the not-for-profit section as well. Okay, insolvency safe harbour. This is a really interesting one. Companies are allowed to trade whilst insolvent. So the government announced this on 20th March 2020, so 6 months from that date, that you are allowed to trade whilst insolvent. However, if you have a financial report that's due within that 6 months, you still need to make your solvency declaration. And the company must declare that in the solvency declaration that there are reasonable grounds to believe the company can pay its debts as and when they become due and payable. So that's what we normally say every year in our financial report. But now that we're allowed to trade whilst insolvent, that might need to change. Keep in mind, however, I did speak about going concern before. Going concern is different to solvency. You may have a business that's trading whilst insolvent right now. They're not able to pay their debts as when they're due now. However, they're allowed to reopen and start trading again. They have a plan to continue as a going concern. So it's a really unique environment at the moment where the solvency and the going concern can go different ways. But do keep that in mind. It's great to do the assessments at the same time. Now, when you get to the financial report, you need to consider whether that declaration is appropriate, the one highlighted in orange. Because if it's not, you need to adjust it. Never before have I seen a declaration that is anything other than what's written there in orange. So this is a really interesting to see what comes out of it. There is guidance that's issued by ASIC for this exact situation, however, and it dates back to the 90s, and I read it the other day. It's quite interesting. But if we're in a situation where the business is trading whilst insolvent under the safe harbour, you'll need to update the statement to say whether it's qualified in that we may not be insolvent, we may be solvent, maybe not be insolvent, or you can have a negative statement, just say we are insolvent. And when the auditors do their audit report, the auditors need to cover off on this declaration as well. So here's the 3 options that you might end up with your director, the solvency statement. You may end up with the plain old, the company can pay its debts as and when they become due and payable, or you might be insolvent. The company will not be able to pay its debts as and when they become due and payable. And ASIC will be fine if you actually say that because you've got the safe harbour. Or I think the last one will be a little bit more common. Well, not as common as the first one, hopefully. But it says we're unable to determine if the company will be able to pay its debts as and when they become due and payable. That's called a qualified statement. So it's somewhere in between. It's saying we're not confident that we are trading insolvent, but we're not sure that we're not confident that we are trading solvently, but we're not going to call it that we're insolvent just yet. So you've got those 3 options to look at. All right, so I'm running a bit behind on schedule, but I really do want to bring Marty in to give you some insights into what he's going to be looking at. So Marty's auditing in this environment. He's issuing those audit reports. He's going through the files. So he's going to give you a bit of insight into the struggles that he's going through and maybe some tips to hopefully make your audit season a little bit easier.
Excellent. Thanks, Hayley. Appreciate that. So thanks, everyone. I guess as an audit partner for mine, the greatest challenge facing companies this reporting season will be validating or road testing the many assumptions used in preparing your financial reports. So what assumptions am I referring to there? It's the assumptions used to prepare your going concern memorandums and the budgets going forward. And it's also those assumptions being used in your discounted cash flow models used in your impairment models. I think thankfully most of our clients have weathered the COVID storm well due to the way that businesses have pivoted and adapted well and reshaped their business models. And also the available government stimulus has given businesses a greater chance of survival. I guess as Nathan's experience has shown with pure fishing, COVID has and will continue to impact the consumer behaviour. So I don't think companies can blindly use pre-COVID assumptions regarding growth or assume the demand for your goods and services will be the same going forward. I've heard something recently. They said that psychologists say that habits are formed or broken within 7 weeks. So now that lockdown's almost 3 months old, there's certainly no guarantee that consumers will revert to their own old ways once the restrictions are fully lifted. A good example of this might be the domestic flights. When domestic flights resume and the borders reopen, it's hard to see how commercial flights between, say, busy centres like Sydney and Melbourne at pre-COVID levels again, given how well everyone now knows how to use Zoom and Teams. Accordingly, for the purposes of financial reporting, there needs to be a critical assessment of the assumptions used to ensure they are realistic and take into consideration any changes in consumption patterns as a result of COVID. As always, in an audit process, documentation is key. So going concern and impairment memorandum should be prepared that outline those key assumptions used and their rationale. I guess another area of audit focus for us this year will be that new lease standard. Some clients may have already done their calculation and disclosed the likely impact of AASB 16 in last year's accounts. The standard does require estimates regarding effective interest rates and renewal terms, so it's important to revisit those estimates to make sure they remain accurate, given the decline in interest rates here in Australia. And COVID's shown that commercial property probably isn't as much of a necessity as it once was, which may impact how future lease renewals are accounted for under the standard. As Hayley alluded to with her JobKeeper presentation previously, eligibility is the key audit risk this year. You might have seen in the papers the ATO starting to get really active and making sure that people who are claiming that stimulus are entitled to it. So certainly, as part of the audit process, we'll be looking to ensure that you have the requisite information to support the registration. From an audit perspective, for those clients that have inventory, stock take attendance is a traditional audit procedure, which may not be possible this year due to lockdown protocols that are in place. So audit teams and clients will need to certainly have a discussion as to whether there are alternative procedures to gain comfort over the existence of inventory at 30 June. Otherwise, there may well be a limitation of scope qualification in this year's audit report. From a practical auditing perspective, it's unlikely there will be teams of auditors descending on a client's premises this year. You might be taking a deep breath thanking for that. But it's really important that information can be provided electronically between both parties, and communication protocols are established between yourselves and the audit team to make sure the process is as efficient and effective as possible. From an audit report perspective, ASIC have certainly suggested that they expect to see a significant increase in emphasis of matter paragraphs within our audit opinions, whether it be a material uncertainty regarding going concern or a material uncertainty regarding the impact of COVID-19. So keep an eye out for it. I think it's one of those key areas that we need to be ensuring that both parties are on the same page. So in summary, for mine, the key will be for you, our clients, to now document your conclusions regarding going concern and impairment, including those assumptions that are realistic in a post-COVID world. Those key documents may have a significant impact on how the June 2020 financial report and audit opinion will look. So it's important for both parties, as I mentioned before, to get on the front foot now in June and ensure there are no surprises when it comes time to finalising the accounts and the audit opinion. Of course, we look forward to working with you, our clients, to meet those challenges and to ensure the reporting season is as smooth as possible. Thank you, and back to you, Hayley.
Thanks, Marty. Good insight there, some good advice. Now, we are getting short on time. There's some resources here. You'll get the slides, so click on those links when you get them. Now, we're due for a 5-minute break, but I've got some questions in. So if some people want to duck off and grab a coffee now while we have a break, and I'll answer the questions at this point in time. Now, the first 2 questions that have come through, they relate to the payroll tax refund. So the payroll tax refund was paid first, which is great for a cash flow basis. And then subsequent to that, we've gone and checked whether we've been eligible for it. So what would have happened, so this is the first and second question are quite similar, so I'm going to answer them together. So when you get your payroll tax refund, what's happening is you're getting the money in the bank and you're going to credit your payroll tax because you don't have to pay that tax anymore. So debit cash, credit payroll tax. Now, we get to the end of May, or we're getting to June, and we found that we're not actually entitled to that, so we've got to adjust it. Now, we do need to take up the accrual because we know we're not entitled to it. And what we'll do is we'll actually debit out the we'll debit the payroll tax to put that expense back in there and then credit the accrual. The difference between whether it's an accrual or payable will be whether the government's actually asked for the money back or not. But generally, it is going to be a liability, and we do have to reinstate that payroll tax. So hopefully that answers those two. Now, another question that I've got here relates to the cash booster. So the cash booster is different to the payroll tax refund because you're not getting any kind of tax concession, or you're not getting it's not a reduction of any expense. What's happening instead is the government's just filling your pockets with some cash. They do link it, like the calculation is linked to PAYG withholdings. However, PAYG withholdings, they only relate to amounts that you've collected from staff. It's not actually an expense for your business. So it is just simply a cash boost based on PAYG withholding, which means that the entry for that would be we'll debit the cash when you get it, and then you're going to have to credit the government benefit received. So it'll go straight to income. There's no PAYG amount that you can offset, or there's no liability you can offset. It has to go to income because it's a cash boost. So hopefully that answers those questions. I'm just going to stop myself just to have a 1 minute break, and then I'll get back onto it if that's okay. If there's any other questions, feel free to pop them up. Okay, so hopefully that's been enough time for everyone to get a quick drink. Sorry, we're running a bit late, lot to cover. I've also just had another question come in relation to lease concessions and whether the depreciation and interest are recognised as you continually go with the original model, and then the rent concession is the difference that goes to income. And that's right. And I did have those examples up there, which I didn't go through in too much detail. It's the table here, which will show you how that works. So you can still see that the interest goes through and the depreciation goes through as per normal. And it's just the concession part that goes through to the difference through to the P&L. Okay, so that should be all the questions answered. I'll try and make up some time now. Okay, and talking about lease concessions, we're going into leases. Hopefully you've already got a good head start on what's within leases and you understand how they work, but I'll take you through some complexities in it. We'll also talk about special purpose financial reporting reform, and then at the end we're just going to have a bit of a forum where I bring in some of the partners from the PKF firms to talk about some reporting areas of focus. All right, so now leases, 7-step model. Let's make it nice and easy. First of all, you got to assess if the agreement contains a lease. So look beyond agreements that you previously said lease at the top. You've got to look a little bit deeper into all agreements to see if there is a lease. There's a definition of lease, which will be coming up on the next slide. Use that to determine if an agreement actually contains a lease. And then have a look at whether the exemptions can be used. So there's the short-term exemption. So if the lease is 12 months or less, you don't have to apply lease accounting. Or if the underlying asset is a low value, and the the guide here is if it's under $10,000, then you don't have to account for the lease on the balance sheet. If you don't get to use either of those two exemptions, move on to the third step, which is determining what the lease term is. Now that can be a bit tricky, particularly if I've got undocumented leases and the like. I will go through that in detail coming up. And then the fourth step is to assess the future cash payments. So have a look at what you actually pay per month for what the item is that you're leasing, and consider whether there's any variable payments. So there's all different types of variable payments, but keep in mind if you've got things where the future payments will be dependent on CPI and the like, or there's also variable payments where we don't know what they'll be. If you're paying per page of photocopier, then that'll go straight to the P&L and only be the fixed ones that go through. Also have to think about non-lease components. So if you lease a building and it includes things like outgoings and the like, they're non-lease components. So you've got to decide whether you're going to strip them out of your lease calculations or whether you're going to include them. Once you've got through that step, step 5 is determining an appropriate discount rate. So by reference to your incremental borrowing rate is a good one if it's not implied, if it's not actually stated in the lease, which I'm yet to see one. And then once we've got all that, we can calculate the discounted lease liability using a lease schedule. You can do it in Excel. There's plenty of models out there as well. We can provide you a tool if you're not sure about it. And then once we've got the lease liability, that will generally calculate to be what the right of use asset is. So follow those 7 steps when you are assessing your leases. As per the standard, a lease is a contract or part of a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. One sentence with lots of things going on in it. So it can be a contract in its own right, it can be a part of a contract, but it must convey the right, so you've got the right to control the use of an identified asset. You need to be able to identify the asset as well for a period of time. So you've got to work out what that time is when you get to control it, in exchange for consideration. A lot going on there. So use that to work through all of your arrangements and find out whether they do have a lease in it, whether they are a lease arrangement in their own right, or there could be portions of it that contain a lease. Very tricky definition. So I've got some questions here. Might need to use the chat box to put your answers in if you get a chance. So with that in mind, with that lease definition, I just want to know, is a designated car parking space included in a lease arrangement or not? For instance, if I'm allocated spot D4 of level 4 to park my car, would that be considered a lease? Now let me see if I can get the chat box up to see whether we get some yeses or no's in there. It depends. That's always a good answer. It depends. I've got some yeses and no's. One yes. Yeah. All right. The answer is yes, because it's an identified asset. So we can actually identify that it is at spot D3 of level 4. So it will, it does depend on other terms of the lease, but yes, it will definitely be within that lease if we are paying for it, if we can identify it, and if we get to control it. So if I get to write my name on that parking spot, I get to control that asset as well. So the second question, is an undesignated car parking space included? i.e. you can park your car on any spot on any of the 5 floors that are available. We've got some yeses and some no's in. Looks like we're going for majority of no's here. If you said no, you're right. It's not if it's undesignated. If your lease is for a parking spot, but it is any spot on the 5 floors, you don't get to control that asset. It is not an identified asset that you are leasing. Therefore, it will fall outside of the scope of the lease standard. Another one is an agreement to use up to 100 terabytes of cloud storage considered a lease. Got some yeses and some no's. No, no, no. Yes. No, it'd be a bit tricky to control that cloud really, because when you've got that 100 terabytes, you don't know whether it's going to be on the server that's in this country or whether it's going to be on a local server or where it's going to be. So you don't get to control that particular asset. So it might not fall within the terms of a lease agreement. And then the third one is the lease of a pop-up shop, which can be relocated to any part of the shopping centre. So, you know, those ones that sell sunglasses and the like. Would that be considered a lease under AASB 16? Okay, so that one's a bit mixed, 50-50. For this one, I'd again go with no. It's not considered a lease, because if you can't control where your pop-up shop is going to be from day to day, so if centre management is going to move you from one spot to another, you're not controlling the identified asset, so you're going to be scoped out of it. So if I go back to this definition again, over here. So you need to have the right to control the underlying asset. You need to be able to identify the asset that you control, and you need to have it for a period of time. So all those examples we're talking about whether we've got a right to control it, so where it is and do what we want with it, and whether it's something we can actually identify where it is. So if you're leasing capacity of a pipeline and the like, you don't have the whole pipeline, so therefore you're not in that area where you can control that underlying asset, and you can't identify that separate asset as well. So it's a really good definition. It's only small, but it's tricky. So keep that in mind when you're going through all your agreements as to whether we have a lease or not. It doesn't have to say lease at the top. It might say something else like contract for services, or it could have services as infrastructure as a service is one that I've come across before. It may actually have a lease within it, even though it doesn't use that terminology. All right, so another tricky area within leases is enforceability or term of the lease. So what is a lease arrangement? The arrangement is a contract, and a contract definition, that'll come from AASB 15, which is our revenue contract. So AASB 16 and 15 are going to use the same definition for contract. A contract is an agreement between two or more parties that creates enforceable rights and obligations. So it doesn't state anywhere there that a contract has to be written. It doesn't state that it needs to be approved and signed. So really, a contract can be verbal or implied. It just comes back to whether that agreement can be enforced and whether the agreement gives rise to rights and obligations. So leases, they don't always have to be documented. It can get really difficult, particularly if you've got intercompany leases. So if you've got one business that owns the building and the lands, and they're leasing it over to one of the subsidiary businesses. There is an unwritten agreement there that yes, the subsidiary can use the land and buildings. Even though it's not written, it's there. And there may be enforceable rights and obligations, but we won't know until it's tested, will we? Okay, so lease terms. They can either be, if you have a documented agreement that's easy to understand, the non-cancelable period of the agreement. So that's if it's reasonable that you're going to run that term, that'll be what the lease term is. Or the lease term can actually be shorter than the agreement period. So if you've got a lease for a building that goes for 5 years, but you decide that because of COVID-19, everyone's working from home now, so after 2 years, we're going to actually terminate this lease. And when you calculate this lease, you only calculate it for the 2 years in which you intend to use it for. But you also need to include the cost of any exit fees and the like. So it can be shorter than what the contracted agreement period is. Or it can be longer than the agreement period. So if you've got a lease that goes for 5 years for the office space, but you've put significant effort into letting your customers know where you're located and you don't want to change your address yet, you might want to extend that option 5 years if it's written into the lease, then your lease term will be longer than that non-cancelable period of the lease. So it's very subjective. It's not necessarily my lease says starts in 2020, ends in 2025. You've got to think about what's going on in the background and how you intend to use the underlying asset. Now, if we take that and we consider an undocumented lease, the term of an undocumented lease is something that you might need to work out. And by doing that, you'd have to have a look at when a termination would occur. And a termination, also whether a termination clause will cause a significant penalty to the lessee. So a penalty might be, I've got a list of them there, but one of the big ones would be having to relocate your operations. I want to use an example where you've got a lease for a building, and then within that building, you needed to customize that building for your specific business operations. Now, you've invested a fair bit of money in customizing that building. You might have put in some false floors and the like for cabling. You might have put in some specialized equipment that's been integrated within that building. Your intention is that you're going to be using that equipment for a very long time, even though your lease might be 5 years or it might be undocumented. So the termination of that lease, if you wanted to say that it was only 1 or 12 months, would be the cost of having to remove all of that equipment and find another place to reinstall it. So that penalty might be quite high. So you've got to think about that when you're trying to work out what the lease term is going to be. If you've invested that much money in there, your lease term is likely going to be the expected life of those improvements that you've put in there, because you've invested in them for the long term. So those false floors and all those customizations you've put in might last 10 years. So therefore your lease life might be 10 years rather than what's documented, or if it's undocumented. So I've got an example about how this works. And I think the biggest troubles are going to be in related party examples. So in this example, I've got a trust, which is controlled by the shareholders, but it's not consolidated in, and owns some land. We've got a holding company that has built a building on that land. And then a trading company performs office functions from the building. There's no documented lease agreements anyway, because they're all related parties. Now, if we're not auditing, we're preparing the financial report, sorry, left a bit of an error in there, of the holding company, which controls the trading company. So first of all, is there a lease and how many leases? So with nothing documented here, we still need to look at what's actually going on here. Do we have an identified asset? Do we have the right to use the identified asset? And is there a period of time? So the building that is built on the land, I'd probably say yes, there is a lease here, because the identified asset is the land that you're using. We've got the right to use it because we've put our building on it the way we want it. And then what the interesting part is, what is the actual term of that lease? What is the time frame? It is likely going to be the useful life of the building, because that's how much you've invested in that building to put it on that land. So now we have a lease between the holding company and the trust, which is going to be, say, 10 to 20 years because of that building. So if we are preparing the financial report for the holding company, we need to express that and put that right of use asset in there for the land, and any future lease payments, if there are any, including them in there as well, which gets really confusing. Now, if we go down to, there is another lease, so there's two leases. That was one between trust and holdco. The second one is between holdco and trading company. So the trading company performs office functions from the building. So if we go back to what those penalties are, like we do have a lease here, we can identify it. So we know that it's the lease of the building, and that they've got the ability to use it. We've satisfied all that, but now the lease term. What would be the penalty of them exiting that lease agreement? It might be quite easy for them to pick up office functions and head over to another office, and there might be availability of office functions elsewhere. So that lease term may actually be less than 12 months. And if you assess that that lease term is less than 12 months, then you might be able to get through to the short-term lease exemption. But all of this stuff is very subjective. It's very difficult to understand. I think the best way to look at it is if you've got significant assets that have been built on leased property, then you'd probably look at the useful life of those assets to find out what the true lease term is. If you don't have those significant improvements there, look to other things such as, is it easy for us to change address? Is there other buildings available? Is there other assets available that we can use? But a little bit of research that needs to be done there, and it is a bit tricky to get to. At the end of the day, once you've done all this work to try and find out how long your lease term is, it's a good idea just to document it, have it set in a policy, have it signed off by the board, so that then we pretty much have a documented lease term so that we don't end up in this mess going forward. Now this, I've just put the last question in there, is do we need to be concerned with all of the leases? So in this instance, if we were doing consolidated set of accounts, don't forget that the lease between holdco and trading company will get eliminated out. So you probably won't spend too much time on that one anyway. It's only the ones that you actually have to do the financial report for that you have to start digging around for this information, but it can cause a bit of drama. Now, this interpretation of what the lease term was, this only came out from the Interpretations Committee in November last year. So we're expecting a fair few changes this year as a result of that, and a fair bit more work that's needing to go into it. Okay, another tricky area within leases is whether we've got reassessments and modifications. So some businesses have successfully implemented the leasing standard and they're moving along just fine. They've done that 7 steps that I spoke about previously. But now what's happened is we may be 12 months down the track, maybe 6 months down the track doing another financial report. And we have to look at whether we've got to change those leases that we've got there. We have to do lease reassessments where things have changed within the lease that was already existing. So that might include if you intend now to exercise an option, or if you intend not to exercise an option. So it might be an option to renew. So last year your lease might have been 5 years, but now because you intend to take up an option, it might be 10 years this year. So we need to put that through the balance sheet. Or if you've got a change in your future lease payments as a result of CPI. So your CPI rate has come in, the lease payments have changed, you'll need to adjust that for your future lease payments because they've all gone up going forward. Now, what we do with these reassessments is we only adjust the balance sheet. So it only goes through to the right of use asset and the lease liability only. There's never an amount that goes through to P&L. However, there is a little tricky part because as soon as you adjust your right of use asset, you then need to go and adjust your depreciation on that asset. So there's a fair bit going on there as it is, and that's the simplest kind of modification you can get, which is called a reassessment. Now, the next part is a modification. Gets really tricky here. So a lease modification is where we've got to change the lease term that did not exist at the commencement of the agreement. So it changes the scope of a leased asset if you've got an extension to the lease that you didn't otherwise have previously, and if it wasn't an option, or if you've decided that you want to add on an extra floor to your lease, or if you want to take away a floor from your lease and the like. So if we're changing the actual scope of what the underlying asset is, then we need to look into lease modifications, and we need to decide whether it goes through as a separate lease, or if it doesn't go through as a separate lease, we've got to remeasure the existing lease. So I've got a bit of a table on this page to help you decide where it goes. So if the increase or decrease in the scope, or if the increase in the scope of the lease is equivalent to the price that you're paying, then that part will generally go through as a separate lease. If not, then we'll need to go through and remeasure our existing lease liability and right of use assets. So we'll get into these tricky ones over the page. So separate lease, nice and easy. We've got a new scope, we've got a new floor that we're leasing out. We're just going to pop that through as a new lease in the lease schedule. Or we'll expire our old lease and put in a new one. With any gains or losses from the old lease expiring, that'll go through P&L. So that seems pretty simple. Will be some P&L impact there. If we don't have a separate lease, firstly, we need to assess the impact of the change in scope. So I've put a bit of an example here. If we're to reduce our leased office space by 25%, and in return our lease payments reduced by 25%, we will reduce the asset and liability by 25% on our balance sheet, and any difference will go through to the P&L as at the date of the modification. Where that difference arises from is because the asset may be depreciating at straight line, whereas the liability, because you've got the interest amount, is front loaded, you've got more expense at the start, you're going to have a difference between your asset and your liability at the date of the lease modification. So that'll be the first step of doing a lease modification, put that through to the P&L. The second part is, because we've entered into lease modification land, we have to adjust our discount rate. So the discount rate might have been 8% when we first took out this lease, and now that we've got this modification, the appropriate discount rate is 6%. So the second step is, for the future lease payments, go and recalculate what they are using that new discount rate. Any difference that comes out as a result of you changing that discount rate, that'll go to the asset balance. So you've got to make sure you get these steps in correctly. So the first one is where you've got to put the difference through to P&L. And this is based on you changing your office space and changing your future liabilities. Second step is a discount rate. The impact of the discount rate will change the right of use assets. And then, of course, you've got to adjust all of your depreciation going forward. So it's quite complex there. I have a feeling this is where Nathan at Pure Fishing might end up with his lease concession that he negotiated. So a few steps to go through there, because he's actually got a lease extension. It's got a longer term, so that will increase the future payments. Okay, now I do have a detailed example on this, but I'll leave that for you to go through in your own time when you get the slides. And in a second, I'll just check to see if I've got any questions that have come through. Do novated car leases ever fall within the definition of a lease and need to be on the balance sheet? Generally not, because a novated car lease is where the employee actually has the car lease and they're just novating the payments over to the employer. So generally they won't fall on there. Unless you own the lease and you're novating it somewhere else, then it might fall within the scope. But generally, no, novated car leases are off the page for leases, which is great. I haven't had any other questions come in about leases. I'm not sure, when I had the technical difficulties before, I might have missed questions. So if I haven't answered them, please pop them back in the box, because it did a bit of a reset for my computer. Okay, so quick one on financial reporting reform. Those of you out there who prepare special purpose financial statements, they will be a thing of the past soon. Now, this is gone through at the AASB, they've approved it. We are removing special purpose financials, but the first phase is with the for-profit private sector entities. So from the 1st of July 2021, if you fall into that box, you will need to move to general purpose financial statements. You won't be able to use special purpose anymore. In addition to that, our old reduced disclosure regime standards will be replaced. We're now going to have, it's a new standard, AASB 1061, which is our simplified disclosures standards. Now this standard, it's an all-in-one. It's great. You can just go to that one standard and it's got all your disclosures from start to finish. Whereas previously the reduced disclosures had it all highlighted throughout all the other standards. So it's mandatory from 1 July 2021. However, all entities are encouraged to transition early if they're impacted by this. So you can use that simplified disclosure standard now if you wish. There's also incentives for early adoption, such as not having to go back and restate your comparatives. Yeah, I think that's pretty much it. Not having to restate all your comparatives, which knocks out a lot of your disclosures. But if you wait until 1 July to transition, you won't get any of that early adoption, which means you'll have to do a full transition, which is showing 3 balance sheets and the date that you transition over to general purpose. So I'll just quickly jump back to leases. I had a question that come in. How often do we need to reassess the discount rate? That's a good question. The discount rate will only be reassessed where you have to do a lease modification. So you don't have to do it every year. You don't have to go through and adjust that discount rate. It's only where you've got a lease modification or a lease assessment that you are changing it. Apart from that, you can set it and forget it. Okay. Now, just a bit of word for warning for large proprietary companies. So from 30 June 2020, the thresholds for who is a large proprietary company doubled. And in doing that, Treasury noted that those companies that are still exceeding those thresholds are considered to be economically significant. Now, ASIC and the AASB have noted that those entities are likely to be reporting entities. So I've got the thresholds in there. If you're exceeding those and you're a large company, you might want to consider whether you need to change to general purpose financial statements for 30 June 2020. So even though it's not mandatory until 1 July 2021, this may mean that you have to go early. If you are going to still continue with special purpose financial statements, you're going to need some strong supporting documentation just because of those announcements that have come out from ASIC and AASB. The auditor may be looking for that as well. And in addition, there's a new standard that requires us to disclose why we're preparing special purpose financials if we're doing that. So just that documentation and the support around why we're non-reporting entities, that's just got to be ramped up from this year going forward. Or you can bite the bullet and move over to general purpose financial statements if it's not too much hassle. So this is the new disclosure that I was mentioning, the AASB 1054. So if you're preparing a special purpose financial report, you'll need to include recognition and measurement disclosures. That's what the R&M is. So in that disclosure, it'll sit within note 1. You'll need to state whether the financial report complies with accounting standards, or if it does not comply in certain areas, or if you have not assessed the compliance with accounting standards. Must also disclose about consolidation and equity accounting. So if you're doing special purpose financial reports, if you're doing single entity financial reports, you've got to include the names of all of the subsidiaries and associates. And then you've got to explain why you're not consolidating them in that financial report. However, if you're a not-for-profit entity, you don't have to do that control assessment. You can just state that you haven't done the assessment. So for those for-profit entities doing single entity financials for their holding companies, unfortunately, this disclosure will mean you have to put in at least the names of all of the subsidiaries that you haven't consolidated in if you're going to continue to do the special purpose. Okay. So I just got a question. Our company has year end on December. If the special purpose ends on 1 July 2021, does that mean we must adopt early? No, you don't. So the June year ends will be leading this one. So for June 2022, that's when they will be doing the general purpose. That means that then it'll be December 2022 that you will do general purpose. So you get a little bit 6-month extension on what the June year ends do. Okay, all right, so in terms of timing, we don't have much time left, but this would be a really great one. This is a panel discussion. We've got Ken Weldon, who's just turned his camera on. Hi Ken, how are you going? Ken is a partner in Melbourne. He's got over 25 years experience in commercial and financial roles. He understands the importance of the right quantity of the, sorry, my computer's plugging in for me here. Right quantity of the right time in informing corporate decision making and financial reporting outcomes. To me, Ken is a corporate governance expert. He knows everything about it. He's my go-to guy in that area. He's a great source of knowledge. We've also got Kim Riley, who's our audit partner in Sydney with 11 years experience. I've worked with Kim for a long time. She works with a range of clients, particularly not-for-profit area, but also some large multinationals. She also works closely with the Governance Institute of Australia, and she's really keen on promoting ethics in the accounting industry. And then we've got our mate Tim. He's an audit partner in Brisbane with 15 years experience. He's performed a number of commercial secondment roles, so he's worked in the role of a CFO and a financial controller, which is great. And he does advise several boards in the school and not-for-profit space. Tim's main audit clients are their large consolidated entities, a few on the ASX, as well as those which are owned by multi-corporates. So, hey guys, welcome to the discussion. Now, I've just got a few questions that I've prepared. So this is just to give our attendees some insight into some areas of focus for the 2020 financial reporting season. So I'll put it out there, with ASIC being our main regulator, what's their areas of focus for this year, particularly given the impact of COVID-19 and the current financial reporting situation?
Yeah, I'll take that one, Hayley. Hi, everyone. Nice to see you all. Look, ASIC areas of focus are still going to be consistent with prior years, being the revenue recognition disclosures, off-balance sheet arrangements, impairment testing, asset values, and tax disclosures. But obviously, they'll have some heightened focus on particular areas. We've touched on this already, but one of the main ones is going to be around disclosures, making sure that financial reports are transparent, clear, and concise. From a financial reporting perspective, this really looks at the going concern disclosures, beefing up disclosures on key accounting estimates, including disclosures on sources of estimation of uncertainty and key assumptions, looking at scenario analyses and sensitivity analysis. And also your subsequent events disclosures, as Hayley's mentioned earlier, looking for those post-balance sheet impacts of COVID-19, because obviously that's still evolving. Other matters to consider in terms of disclosure around your hedge effectiveness, sales returns, and of course the leasing standard as well. As Nathan mentioned, if you've got rent concessions or anything kind of changing in your lease, which a lot of companies will, making sure that that disclosure is up to scratch. And then I guess the other area of heightened focus that we see is around the value of assets and liabilities. Again, Hayley's mentioned that earlier, but making sure that when you're looking at the value of these assets, and financial and non-financial, that you're considering the solvency and going concern risks. Things to consider include business and economic factors, industry-specific factors, your impact on customers, your impact on the supply chain, any capital raising, like Hayley mentioned earlier. If you're planning on doing capital raising, is that still going to go ahead, and what's the likelihood? And management plans and responses to the crisis. So yeah, that in terms of the impacts, I would say value of assets and liabilities and disclosures are going to be the key areas that they're going to focus on this year.
Yeah, good afternoon, everyone. I guess I'm an optimist when it comes to these things. So let's have some good news. I guess unlike in previous years with multiple accounting standards happening at the same time in terms of being introduced, with the exception of lease accounting, which I think we've all been talking about for a number of years, it hasn't just crept up on us by surprise. So if you take lease accounting aside, there are no new accounting standards for this reporting period. And similarly, the ASIC focus areas, if you look at their communications, are broadly similar to what they've been putting out in previous reporting periods. So there's nothing new in that sense, but clearly the context around which we're preparing the accounts through June is fundamentally different from before. It's not every year you get a global pandemic, obviously. So I guess the way in which we have to prepare them and the way in which we have to audit it is clearly impacted by that context. But the good news is there's nothing new in there. So.
It's interesting. I think impairment's definitely one that's always at the top of the list for ASIC, but yeah, it's definitely interesting with the current economic environment from COVID-19. But I read an article the other day about a business that wished to disclose their profit impact from coronavirus as a separate line item to the rest of their profit impacts. Does anyone have any views on that, on separately disclosing your COVID-19 impacts and whether that can be done?
So this takes us into the area of alternative profit measures, and I guess there's a very clear principle here that's worth remembering, and again it's a principle that's been there for some time, and that is that non-IFRS profit measures, so something that isn't prescribed by the accounting and auditing standards, and they are considered by ASIC to be likely to be misleading, and that's a view that they have had on a consistent basis over a number of years. And for those of you who are in the listed space, whenever you put out your investor reports, your ASX updates, and of course your financial statements, this kind of caveat quite often appears around, underlying NPAT or underlying EBITDA or, normalized earnings are all non-prescribed metrics by the Accounting Standards Board. The directors may include them because they think they're meaningful in gaining an understanding of the performance of the business. You have to put that caveat in, and that's a long-standing principle. Obviously, COVID is front of mind for many now. So again, ASIC stance, which is included in their Q&As, which is a useful reference point for anyone looking through the next few weeks, is that anything pre and post-COVID, in their view, is likely to be hypothetical. It's not possible to accurately and specifically and reliably identify and quantify the impact of the pandemic is their starting point. And certainly any attempt to do so should not be given undue prominence and should not be used as an opportunity to hide bad news. And again, consistent with where they've been coming from. So I guess their Q&A is very explicit. Any results should not be split between pre-COVID and post-COVID on the face of the income statement or in the notes. Clearly, there's an opportunity to discuss the impact it's had, whether that's on a quarter-by-quarter basis. But again, it's not intended to perhaps overemphasize what is happening. Just as a postscript to that, one of my listed clients that I actually act as the internal auditor on has recently experienced that, and that they attempted to tell a story of what COVID had done to the business without necessarily falling foul of ASIC's view here. The interesting aspect is that the analysts then phoned up and gave them a hard time saying, you must be able to tell us what the impact is. So again, for those of you in that space, that conflicting message between what the regulator wants us to do and what's expected in line with precedent versus what the analysts are looking to take out just goes to that point about strong and regular engagement, because it would be the wrong thing to give information purely to satisfy the analyst if it falls foul of the ASIC guidance in this space. So clearly everyone's got their own COVID story to tell and what has happened to the business, but the way in which you communicate it needs to be given careful consideration.
Yes, I like that answer. So there's always a space for it, but not within the profit and loss, I don't think. So I just want to go back to the safe harboring with the insolvent trading. Because you're all auditors, what would be the likely approach taken by auditors in this kind of a period? It's very unprecedented times being able to trade whilst insolvent. So yeah, does anyone have any insights into what you do there?
Yeah, thanks, Hayley. I'll take that one. As you said, there's this temporary relief available, for up to 6 months for directors, personal liability, and incurring the debts where a company is or maybe trading insolvent in certain circumstances. So, us as auditors of a company, when we suspect that the insolvent trading provisions or really any other duties of directors under the Corporations Act have been contravened, we are required under Section 311 of the Corporations Act to report that matter to the ASIC. So given these amendments, as you discussed, Hayley, a company can continue to trade while insolvent. That may not be a contravention under these amendments. However, the auditors report, for example, we need to assess and report on failures of directors, to prevent the company from incurring these debts, if they've been incurred in a dishonest or outside the ordinary course of business. So I guess in summation, our audit approach won't significantly change. It's interesting that the risk of going concern issues and solvency issues has increased, due to this COVID environment we're now in. But on top of that, now the risk has increased of companies and directors being able to continue to trade while insolvent. So it's like a dual risk increase. So, us as auditors, we need to assess both the solvency that's stated in the director's declaration and going concern that's covered in our auditor's report. So essentially, this brings a unique scenario, as Hayley mentioned, where there's some times in some cases where entities may actually be insolvent per the definition, i.e. unable to pay their debts as and when they fall due, but may be a going concern because the company and management still, intends to continue trading. So there's been no determination to cease trading, and it has a realistic alternative to do so. So, from a director's perspective and management perspective, our clients will need to evidence to themselves, and us as auditors, we need to assess this evidence to be able to support the liquidity statement. So such evidence includes an analysis of net ratios, so current ratios, liquidity ratios. Really the underpinning thing we look at as auditors is the detailed cash flow forecast, for the relevant period, which is that 12-month period from the date of signing the accounts. And then sort of as Martin said at introduction to this, is we look at those major assumptions that underlie that cash flow forecast and the loan repayments and capital repayments, and we'll stress test those forecasts and assumptions in line with our current COVID environment that we operate in.
Yeah, no, it's interesting times having to ask for evidence on solvency and test that statement. So also I'm hearing a lot about doing emphasis of matters around going concern and other areas of the financial report. Must be a great time to be an auditor. But you guys, as auditors, what are you expecting in terms of your audit reports this season? Are you expecting lots of modifications and emphasis of matter, or business as usual?
I'm going to try and maintain my optimism when talking about this topic, Hayley, but thank you for the question. So I guess, again, just drawing on Tim's comment, I guess it was important to me that it's impossible, so it is still possible to have an entity which is solvent, but for it not to be a going concern. I think recently we saw the instance of a very high profile retailer, high street retailer, who went into administration, but they have no debt. So a classic example of that scenario. So I guess the expectation that I think the reporting community have is that there may be an increased instance of emphasis of matter audit opinions, which is highlighting that material uncertainty around going concern because of the current environment. But likewise, we can't use that as a get out of jail card. We won't just throw that around like confetti because it's a safe option. And it would be equally wrong to put that up as an option when it wasn't the right answer, as it would be to not put it up if it was the right answer. So I guess the short answer to the question is we probably expect to see more of it, because there'll be many organisations who have had a material impact to their revenue, their top line, their cash inflows, whilst not necessarily being able to put the brake on some of the outflows. That's always to say that some people have done well out of this. If we're in the primary food production area, etc., then look, they're probably having some of the best results known, and I noted, I think overnight Harvey Norman have paid a special dividend because they've had a good couple of weeks on this as well. So I guess it's obviously circumstantial. Every company is different. Everyone needs to go through that assessment yourself. And the importance of scenario planning and looking at different options, obviously, as you have your forecast, is probably more relevant than perhaps the past as well. So look, that's probably where that one is. But I think I've just about to be positive through that answer.
Yeah, what a time to be an auditor. All right, now just moving to the financial reporting reform. So with those companies that are considered to be large companies, despite the thresholds increasing, will you be encouraging them to transition to general purpose financial reports and under the SDS or otherwise this year? Or if not, how are you going to approach that one?
I'll jump in with that one, Hayley. Look, at the end of the day, it's really a judgment call for the directors and those charged with governance. They need to make that call and they need to make that assessment. Of course, we'll be talking through the process with our clients over the next couple of months as to what it looks like for them. But should they wish to continue preparing special purpose financial reports, they'll need to provide a supportable judgment to us on why they're not a reporting entity. For large companies, like Hayley, you mentioned earlier, due to the increase in thresholds, they're more likely to be reporting entities, and they're not really going to have as many options there in terms of how they report in the future.
Yeah, no, it is definitely a judgment call. So I guess just documentation and just setting out that judgment is key. I do think that it's not up to the AASB or ASIC to tell you that you have to move to general purpose, but for you to do your own judgment and find out where you land with that. So then if companies are looking to do their special purpose financial statements as an auditor, what kind of information would you be looking to support that judgment call?
Yeah, Hayley, I think Kim's raised a brilliant point there. This decision needs to be made by those charged with governance. So for starters, with us as auditors, we're looking for almost a chain in decision making when we start making this assessment. It's not something that the financial controller or CFO can determine in isolation, or us as auditors. As Kim said, we can't determine this, and yourself, the regulators can't determine it. So as us as auditors, we're looking for that chain. It might be driven by the CFO, but it needs to be signed off and decided by those charged with governance. So in terms of documentation, one thing that I've seen some of my clients, Hayley, has been almost like a user matrix where you might have, these are the users, and you might list them, and there might be, 5 or 6 different categories of users. And then you run a matrix to say, this is the sort of information that user has access to. And then when you marry up the matrix, you'll see, does each user group have the sufficient documentation they need, in order to be able to make decisions about the allocation of scarce resources. So it's that decision-making process we're looking for as auditors, and also that supportable evidence that Kim's referenced, being who are the users and what information do they have access to, and what information would they need to have access to be able to make those decisions.
Yeah, no, it'd be interesting times. It'd be a one-off anyway, because once we all transition over to general purpose, then it's done. So it's just the next 2 years will be interesting to see what comes out. But in the end, we're going to have one set of rules and one set of financial statements. So things will be a lot clearer come 2021. Well, thank you guys. That's all the questions I've got. Nothing's come through from the participants, but thank you for attending today and giving me your insights. That was very good.